Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. All we ask in return, please refer a friend. Today we're going to be looking at the Williams %R momentum oscillator. It's also referred to as a %R oscillator. This is, in short, an inverted version of the fast stochastics. I'll show you that in a moment. Basically what you have here is an oscillator that is range bound, therefore you can tell when it's overbought or oversold in certain situations if you're trading sideways. You can also spot a strong uptrend or a strong downtrend with it. There's many different things you can do. Basically anything you can do with the stochastic oscillator you can do with the Williams %R. However, there's a couple of things that the stochastic oscillators can do that the Williams %R cannot do, and for that reason alone, I don't really see a reason to use the Williams %R over the stochastics. So that's just my personal opinion, but I'll show you what we can do with this. Whenever you have a situation, you're looking at this and you're wondering where does this line come from? Where do they get this number? What they do is they take 14 periods, the last 14 periods, and that's this number right here. What they're doing is they're taking the close versus, or in relation to the highest point in that 14 period and the lowest point, and they're looking at that to get their calculation. If it's at the bottom, if the close of this period was at the bottom of this particular range, then your Williams %R would be actually at the bottom below the -80 line. If it's at the top, up here, then it would be actually up here above the -20 line. But because we're at about the center, it's actually just above the -50 line, or the center line right here, okay? So that's where they're getting that line. When we use the Williams %R as an oscillator, we're looking at it and saying that anytime that the Williams %R moves up above the -20 line, of this line that I've just drawn here, but that's where you're going to start getting toppy. You start getting a pullback here, 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 here. Okay. Whenever you're looking at it again as an oscillator and you see it fall below the -80 line, okay, right here, then that would be where you would be looking for your entry opportunities. All right, or you'd be looking at it being oversold, but looking for a potential bounce to the upside. Some people will simply look at it and say, whenever she breaks down below this line again, after she jumped up there, when she breaks below it again, that's a sell signal. You should short, and they can do that repeatedly. You'll get a lot of whipsaw in that, and I'll show you why in a moment. But in some cases it will work. On the bullish perspective, it's the same way. Once she's pulled down below that, let me clean that up again so you can see these lines. When she's pulled back down below the -80 line, right here, this -80 line, like she did here, here, and here, they look for buy opportunities, and they say whenever the Williams %R jumps back above that 80 line, then that would be a buy signal. That is true in some cases, and in some cases it will give you losses. The basic thing you need to know is the overall trend of the chart before you attempt to use this for an oscillator. If you're trending up, like you are here, then buying when you fall down below the -80 line and jump back across it, like right here, being a buyer there, makes sense because you're in an uptrend. You would then ignore the overbought signals whenever you're in an uptrend. In a situation where you're in a downtrend, you would do the exact opposite. You would look to short opportunities with that jump up here above the -20 line, and then ignore the oversold conditions. Whenever you've got a chart that's very strong to the downside, they can stay oversold for an extended period of time, so they're not necessarily a buy signal just because you get oversold by this indicator. The same applies to the stochastic oscillators. It really determines the trend, determines what you do with the indicator. If you had a situation where you were moving sideways and price activity was just doing this number for an extended period of time, not actually moving higher or lower, you're just trending flat or sideways, then you could use both sides of the oscillator. You could short here, you could buy here, short here, buy here, that kind of thing. The Williams %R can also, like I said, show you when you're in a strong downtrend or a strong uptrend. In a situation when you have a strong uptrend, your pullbacks will not see the Williams percent R fall below the 50 line. Right here, you are a strong uptrend, so when you were pulling back, you did not fall below that. You actually find support at that level and at that zone. Here, when you're looking at a strong downtrend, you're seeing the same thing here, where you're jumping up here and you're unable to break beyond that halfway line, that negative 50 line, and that's telling you're in a strong downtrend. The same thing can be signaled with the stochastic oscillator. Now, some people are bound to attempt to try to use the Williams percent R as a divergence indicator. I wouldn't do that, and I want to show you why. I'm going to really get into this, but a divergence, for those of you who don't know, is when your momentum is doing something different than your price activity. And the idea would be the situations where you have a high point here, okay, on the 24th, corresponding with this high point, and a lower high point here corresponding with this high point, right? So you've got this is trending up and this is trending down, and then they would be looking for this as being a sell signal, basically. And this particular situation here, you would look at it as being pulling back down here below the negative 20 line as being a confirmation that you could do that, and then you would look for it to fall below the 50 line for even that much more confirmation. Well, by this time you're here, so you start shorting expecting to sell off, and you don't get it. You may have got it later, maybe you want to stretch it out that far, but I'll show you why I wouldn't do that with this. It's not exactly the same thing as the fast stochastic, so let me show you that. Okay, here we're looking at the two different indicators side by side. What the Williams percent R really is, it's just very simply the percent K of the fast stoch. I mean, it's identical. Every single move by the percent K of the fast stoch is tracked by the Williams percent R. Okay, there's not any difference. The only difference between this one and this one is that the fast stochastic has a signal line, this percent D line, this red line, and you'll notice the numbers are different. It's got a positive 80 here and a positive 20 here, and then Williams percent R is actually flipped with a negative 80 here and a negative 20 here. But other than that, the identical information is being posted there. However, George Lane, who is the creator of the fast stoch, he based his divergence on the percent D. So his entire theory is based on divergence of the percent D, which is the red line, and that's not being duplicated by the Williams percent R. So I would argue, or at least it could be debated, that you shouldn't attempt to do divergence analysis the same way on Williams percent R that you would on the fast stochastic. This was so important to George Lane that he actually came out with the slow stochastics to push that point. So yeah, I would use the Williams percent R as an oscillator, first looking at the trend and then using it based on the trend I was in, but I wouldn't attempt to use it for finding divergences. Though it may work on occasion, I wouldn't personally do it. Another benefit you'll have while using the stochastic oscillators, whether the fast, the slow, or the full stochastics, you'll have the benefit of the signal line, which is this red line. That's not available with the Williams percent R. They actually, at stockcharts.com, you can apply a signal line, which is just a simple moving average, to get that benefit. But if I'm going to do that, why am I not just using the fast stoch or the slow stoch or something like that, So I don't really see the actual benefit on my own, other than it is visually more appealing, being that it changes color when it crosses the line, so you can spot it at just a glance. But other than that, I really don't see a big benefit to it. Now let's look at a couple of examples here of what I'm talking about, what spotting divergences here. You've got a low point here and then an equal point here. This is basically just moving sideways right here. Maybe a slight up by minute measurements. Here are the same points using the fast stoch at the proper percent D. So you're looking at this red line here. You see here much higher. Here it's obviously clearly up there, and while price was actually moving down, that is a bullish divergence here. This may be missed. Also over here you've got it again. You've got a situation where you have a low point here and equal low point here. You may look at that as being divergence as momentum was flat, or maybe slightly ever so minutely higher, while price activity was making lower lows. However, if we look at the fast stocks, you'll see a low point way up here, lower low way down here. There is no divergence here according to the method used by George Lane, who actually developed the fast stock to begin with, which Williams percent R turned around and tried to reuse. So I would be leery of trying to find divergences using the Williams percent R. Please take a moment to review our disclaimer. The information provided herein is our opinion only. Under no circumstances do any statements here represent a recommendation to buy or sell securities or make any kind of an investment. You are responsible for your own due diligence. To summarize, we do not provide investment advice, nor do we make any claims or promises that any information here will lead to a profit, loss, or any other result. These videos are for educational purposes only.